Hey guys, welcome back. If you're new here, my name is Senan and welcome to the channel. In this video, I'll be sharing 3 Australian ETFs in 3 different categories, including a couple of new ones that I haven't mentioned before. As the title suggests, each of these ETFs are domiciled in Australia and only contain Aussie companies. Before we get into it, this video is not a buy or sell recommendation for any of these ETFs. I'm just listing different types of ETFs and giving you the key information so you can make your own educated decision. So with that out of the way, let's get into it. So the first ETF on the list today is the BlackRock ASX 20 ETF with the ticker symbol ILC. According to BlackRock's webpage, this ETF aims to provide investors with the performance of the ASX 20 accumulation index before fees and expenses. And the index itself is designed to measure the performance of the 20 largest stocks listed on the ASX. This ETF is extremely concentrated compared to most other ETFs, with only 20 holdings in the portfolio. If you want to check out all 20 companies, you can go to Holdings and hit Select All. So we can see they hold pretty much all of the large blue chip companies in Australia, including BHP Group, Commonwealth Bank, NAB, Telstra, and Woolies. With only 20 companies in the portfolio, this ETF has to be one of the most concentrated ETFs in Australia. It does help that the 20 stocks that they own are some of the biggest blue chip companies in Australia, as highly concentrated funds can be pretty volatile. For those who don't know, blue chip companies are mature businesses that can be quite large, and they're considered to be reasonably stable and safe businesses. There's no such thing as a risk-free investment, but blue chips are among the safest investments one can make. I mean, what are the odds that the big 4 banks, Kmart and Woolies, all go bankrupt over the next 5 years? Odds are it's a low probability. On the flip side, because blue chips tend to be pretty large already, they usually don't have much runway left to grow, which means most of them pay dividends instead of reinvesting in the business. If we look at their performance over the last 10 years, which included a dividend yield of around 4.5%, their average return over the last 10 years is about 10% per annum, and it's roughly about the same over the 5-year and the 3-year as well. And since their inception in 2010, their average return is around 8% a year. Now when it comes to fees, because this is a passively managed ETF that just tracks a benchmark index, BlackRock charge a really low fee of 0.24%. This just gets taken out of your total holdings at the end of the year, and works out to be around 24 cents per $100 you have invested. So overall, this is a pretty low cost ETF, with a really concentrated portfolio of the 20 largest blue chip Aussie companies. It has a decent track record over the long term, and it pays a consistent dividend which comes with franking credits, although that can always change in the future and past performance does not guarantee future performance. I already mentioned the potential volatility with heavily concentrated portfolios, so always do your due diligence beforehand and read the fund's product disclosure statement. Alright, the next ETF is almost the polar opposite of the first. Instead of holding the top 20 Australian companies, this ETF holds the top 300, and that is of course the Vanguard Australian Shares ETF, with the ticker symbol VAS. This is another passively managed ETF, this time from Vanguard, and it seeks to track the return of the ASX 300 index, which is the largest 300 companies in Australia by market cap. Unlike the first ETF on the list, which was very concentrated, this ETF is widely diversified, with a broad range of holdings across many sectors. In their overview, it says this ETF provides low-cost, broadly diversified exposure to Australian companies and property trusts listed on the ASX, and it offers potential long-term capital growth, along with dividend income and franking credits. If we look inside their portfolio, most of their top holdings are similar to the first ETF, because they both hold the top 20 companies in Australia, but they also hold another 280 smaller companies, like Qantas, Novonix, Flight Centre, A2 Milk, and many others. Even though it has over 300 companies in the fund, the average market cap is still nearly $50 billion. So on average, the companies are still quite large in terms of size. Like the first ETF, VAS also pays a partially franked dividend. Currently, their dividend yield is around 4.5% per year, which is paid quarterly and can also be reinvested using a DRIP depending on your broker. If you're new to dividends, I made a quick beginner's guide which I'll link in the description box if you're interested. So if we look at the overall performance for the ETF, with dividends included, since their inception in 2009, their annual return has been around 9.5% per annum, and it floats around that figure in the short term and the medium term as well. When it comes to fees, Vanguard usually charge very low management fees, and for VAS their fee is 0.1%, or around 10 cents per $100 you have invested. Whenever you're investing in any sort of fund, whether it's actively managed or passively managed, always beware of high fees. It might not seem like much, but fees of 1 to 2% can destroy your returns over a long period of time. Usually passively managed ETFs charge much lower fees than actively managed funds, because the passive manager doesn't really have to do much except copy whatever benchmark index they're tracking. And the funny thing is Historically, most actively managed funds have underperformed an index fund in any time frame, whether it's in the US, Europe, or here in Australia. Based on research by S&P Global, over 80% of active funds underperform the ASX 200 over long time frames, which means any ETFs tracking that index will probably outperform active managers as well, as long as their fees are nice and low. So overall, VAS is another solid low-cost ETF. It offers a widely diversified portfolio with 300 of the largest companies in Australia. And it also pays a decent dividend for the investors looking for that dividend income. Alright, the third and final ETF on the list today is an unusual one, and that is the VANEC Australian Equal Weight ETF, with the ticker symbol MVW. This ETF is once again passively managed, and it tracks the MVIS Australia Equal Weight Index. This is a unique index, where all companies in the index are equally weighted, as opposed to traditional index funds that have different weightings for every company based on their market cap. This is a really interesting strategy, and VANEC actually published a white paper on their webpage called Why Equal Weighting Outperforms. This paper goes into the maths and statistics of why having equal weighting in a fund outperformed the ASX 200 over the last few years, with loads of examples and references. It's a really interesting paper and you should definitely check it out if you're interested. This unusual strategy makes MVW a little different from the first two ETFs, who follow the traditional method. If we take a look at the holdings, MVW has a pretty diversified portfolio of 89 Australian businesses, with 74% being large cap businesses and 26% in mid cap businesses. Due to having a mix of mid cap businesses in the portfolio, the average market cap of the companies in this fund is much lower than the previous ETFs, at 24 billion on average. As for the companies themselves, they own a nice mix of large and small companies, including Qantas, Coles, JB Hi-Fi, Domino's, and A2 Milk. On their page they have a full list of all the companies they currently own. As for dividends, right now MVW pay a dividend every 6 months, and their current dividend yield is roughly 2.8% per annum, with 81% of the dividends being franked dividends. If we look at the performance for MVW, since their inception in 2014, they've achieved an annual return of around 10%, with 7% coming from capital gain and 3% from dividends, compared to an overall return of 8.3% for the ASX 200. This outperformance of the index is impressive, but it doesn't mean that they'll continue to outperform a traditional index fund in the future, although it is interesting that their weighting strategy has been working so far. Based on the white paper, it seems they do slightly better than an index in good times and slightly worse in bad times. So their future performance kind of depends on how the overall market performs in the future if this trend continues the way it has. And finally, for the fees, MVW charge a pretty low fee of 0.35%, although it's a little more expensive than VAS and ILC. At 0.35%, it works out to be 35 cents per $100 you have invested. Overall, this is an interesting ETF with a very unusual strategy. It has a pretty diversified portfolio with a mix of both mid-cap and large-cap businesses, and has equal weighting in every company. And since the fund's inception, it's performed pretty well compared to the ASX 200. However, that does not mean it will continue into the future, or that this strategy is guaranteed to outperform. So that's my top 3 Australian domestic ETFs. I tried to include a few different types to show the variety of ETFs there are nowadays. There are so many ETFs out there nowadays that it can get pretty overwhelming trying to narrow it down to just a handful, especially when you factor in US and global ETFs as well. Warren Buffett is a huge advocate of passive investing for most people, and he's always recommended just periodically buying a low-cost index fund and keeping it simple.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore.
The idea of keeping it simple sometimes gets forgotten, but it's one of the most important philosophies when it comes to successful investing. As always, if you have any questions, please don't hesitate to let me know in the comments below. I reply to every single question. If you've enjoyed the video and you want to support the channel, I'd really appreciate if you hit that like button. And if you want to see more videos like this one or join our community, then hit that subscribe button. And if you're still bored, I'll put another video up in the corner that I think you'll find interesting. If you've watched the video all the way to the end, thank you so much for watching. And as always, this video is not financial advice, and I'm not a financial advisor. So please always do your own research before making any investment decisions. So that's it for today. Thank you so much for watching, and I'll see you guys in the next one.